Hello, everyone. I'm Angela Daly, WISE Board Chair, and welcome to a very special presentation today on demystifying retirement plan options, which are many and confusing and not at all one size fits all. WISE is an award-winning nonprofit based in Orange County with a 30-year history. It focused on financial empowerment for females of all ages and all backgrounds. We believe if you manage your money better, you're going to have more options, more opportunities in life, and the end game, a secure and dignified retirement. Very apropos to today's presentations. This is part of a series that we've had over the past year, Retirement Reimagined, which covered various phases of retirement. First, building a portfolio that's right for you, spending it wisely in retirement so you don't run out of money, and a soft side, how to find joy in retirement. All of these are on our website. I learned a lot, and I think you will as well. So check them out. Today's webinar is presented in partnership with State Street Investment Management, one of the world's largest and most prestigious investment firms. They have 6.3 trillion in assets under management. That's trillion, not billion, not million, but trillion. And 1.3 in retirement, trillion in retirement fund assets. So they have one of the most powerful and influential voices in retirement. 4 or 5 decades ago, most Americans or many Americans were covered by their employee plans. They didn't have to worry about saving for retirement. But today, totally different. We're all responsible for saving for retirement, building our portfolios. So it's very critical that we know about the different options that are available so we can avoid some mistakes and also know what's in your portfolio. And all of that takes education. And that's what we're all about today. WISE prides itself on getting the best of the best to present. And that's exactly what we have today, 2 rock stars in retirement planning. Elise Thiemann is Vice President of State Street Investment Management and head of its investment strategy group within the Defined Contribution Group. They have 33 million plan participants. Tina Shackman is Principal, Senior Retirement Plan Consultant at Benefits Financial Services Group, a leading consulting firm on retirement planning. Tina is also a very valued WISE board member. She's been with us for more than a decade. And in fact, it was her idea to do this webinar today. So thank you, Tina. So we're going to have 40 minutes of presentation, then Q&A. You'll put your questions in the Q&A box. And as with all of our WISE webinars, this is for informational purposes only. Please, before making any changes to your portfolio, consult with your trusted advisors. So thank you, Elise, Tina, and over to you.
All right.
Thanks, Angela.
Well, thank you. Very excited to be here. We do have a presentation, so we are going to be putting some slides up on the screen. We also have some polls, so it would be great for everyone to participate. We can get some feedback, live feedback. So I'm going to go ahead and share my screen. And I am going to kick it off to Elise to get us started.
Great. Thanks, Tina. So before we get into the actual content, I did just want to, or we really wanted to take a minute and just level set and just build on what Angela said and just spend a minute on why are we talking about this today, about retirement planning? And specifically, why are we talking about this within the context of retirement planning as a woman? And when you think about women in general, their preparedness for retirement, there's some really good news in terms of, generally speaking, some great statistics of what women are doing for retirement financially. And then there's some not so good news. And then, what can we do about that? So the good news is that, again, this is generally speaking using averages, but generally speaking, women participate in 401k plans more than men, and they also save or contribute at slightly higher rates than men. Women also tend to invest more consistently and trade less frequently than men. What does that mean? It means that according to a study by Fidelity, women's investments in retirement plans actually outperform the investments of men by about 0.4% per year every year. So we're saving more, we're participating at a higher rates, and we're actually outperforming. What's the bad news? The bad news is that even despite that, the average 401k or retirement plan balance for men is around $195,000, while the average balance for women, unfortunately, is only $146,000. More bad news is that women also receive about $4,800 a year less in Social Security on average than men. And lastly, this is kind of a good news, bad news one. Women live about 5 years longer on average than men. So taking all this together, women are doing the right things, saving and investing better, but we have less money in our accounts. And that's really not great because we have a longer life to fund. We actually need more money in our account than men because we live longer. So why is that the case? Largely speaking, it's the income gap rearing its ugly head again. Women are more likely to be in and out of the workforce more due to caregiving, whether that's childbearing, child raising, or caregiving for a family member. That means less money in our accounts from our paychecks, but also less money because we're not getting that employer match. And that also contributes to lower Social Security income. So, what can we do about it as women? We're all taking the first step right now, which is by attending this webinar. And really, this is what we want to focus on today. What can we do about it? We can educate ourselves. Knowledge is power, and the intent of this webinar is to empower you with knowledge, education, and some practical tips. So throughout the presentation today, we'll provide some good hygiene retirement practices, as well as some common mistakes to avoid, hopefully setting you up for a successful and happy retirement, both financially and personally. So with that, Tina, I'll turn it back to you.
Okay. Well, what we thought we'd do is start out with a poll question because since we were talking about retirement planning, we wanted to understand how many of you are actually participating in your employer's retirement plan. So the first poll question, you will answer either yes, no, you're currently evaluating the plan, or I don't have access to a workplace savings plan. So the poll has been launched. And we'll give that a minute or so to get everyone's responses. And then we can go ahead and close that and show the results when we have most of the attendees. Okay, did we close the poll? I don't see results, so I wasn't sure. Oh, perfect. Okay, so 76% said yes, 3% said no, 3% are evaluating, and then 18% actually don't have access to a plan. So that is great. We have over 3/4 of everyone already participating. So you're going to be very familiar with a lot of the terms that we're going to be talking about today. There we go. So let me kind of run through the traditional ways that you can typically save for your retirement. The first place is within your employer or what they call a workplace savings plan. And you have a couple of options normally within those plans. So the first is you can save pre-tax. And that this is within a 401k, 403b, 457b plan. That's typically the type of plan that you could have access to. And on a pre-tax basis, what happens is the money goes into the plan before any taxes are taken out. It'll grow tax deferred, but then when you start taking money out, we start taking distributions in your retirement, they become taxed as ordinary income. Most plans also have a Roth feature, which is considered after tax. And so this means that when you contribute to your plan, it's after you've paid tax, the money will go into your plan. And then as long as you have that Roth feature for at least 5 years, and you attain the age of 59 and a half, and that's a key age that we'll talk about several times through the presentation, you won't have any penalties, and you won't pay any federal income tax. So you really have to think through pre-tax. You're normally going to save because you feel that your taxes will be less in retirement. So you're going to take the tax deduction now while you're making those contributions, and then when you take the money out, it would be when you were normally in a lower tax bracket. That's the philosophy behind saving on a traditional basis. For Roth, what you're basically thinking is that you're going to be possibly in a higher tax bracket when you are taking out money. And that could be just you have a long runway between now and when you're retiring, and taxes have traditionally gone a little higher over the years. It could be that you might be pulling out quite a bit of retirement income during retirement, especially in the early years. So there could be reasons to have Roth money as well. You also have the ability to save outside of your employer's plan. You can save on an individual basis and save in an IRA or an individual retirement account. And you can do the same thing. You can set up a traditional IRA or a Roth IRA, and they work the same way. And you'll see here on the chart that there are different contribution limits, and there's different features for these plans. So currently this year, in your workplace plan, your 401k or your 403b, you can save up to $24,500 using pre-tax or Roth, one or the other or both. You can save in a you don't have to save 100% in pre-tax and 100% in Roth. You can use any kind of combination that you'd want within your plans. If you're over the age of 50, you have the ability to make a catch-up contribution. And this year it's $8,000. And I say this year because these are all indexed and they change pretty much every year. So they continue to increase in their limits. You also may have some restrictions in saving in a Roth in an IRA account. So right now in an IRA, you can save up to $7,500. And you can also save an additional $1,100 if you're over the age of 50. Something to think about with the Roth IRA, there are income limits. So if you reach certain levels of income, you can't actually contribute to a Roth. Same thing is in effect for a traditional IRA. If you're also saving to your employer's plan, you may not be able to deduct all of the contributions you make into your IRA, your traditional IRA, based on certain income limits. So there are some limitations and restrictions that do apply on the IRA side. Having said that, for Roth accounts in your retirement plans, there are no income limits. And a lot of people get that mixed up because they think that because they can't make a contribution to the Roth IRA, they also can't make a contribution to the Roth feature within their 401k, and you actually can. So it's a nice little workaround there for making Roth contributions. The other thing to note here is in your traditional pre-tax accounts, whether it's in a retirement plan or an IRA, once you reach a certain age, and right now it's age 73, you do have to make required minimum distributions. And this is an IRS rule. It just basically says you get to a certain point, they want you to start taking out your money. They don't want you to have that tax deferral forever. So within your traditional accounts, those do have to be made. But with Roth, in the workplace plan or your retirement plan, or your regular Roth IRA, you do not have to make those minimum distributions. So that's one unique feature. The other thing to note is within your retirement plans at work, your employer may make contributions, matching contributions on your behalf. Normally there are what's considered a vesting schedule with that. So a vesting schedule basically says that if you work a certain period, you'll be 100% vested in whatever the employer makes on your behalf. You're always 100% vested on your own contributions. But when an employer makes money, they may put this vesting schedule and say that you need to be there for 5 years before you can receive 100% of those contributions. So something to note there. The next part I'm going to go to is really having gone through all of those different types of accounts, or what are the benefits to contributing to a workplace retirement plan. The first is that it's pretty easy. The contributions are made through payroll deductions. It's a great way for you to pay yourself first. All you need to do is make your election, and your employer takes care of it and makes the contributions directly into your account. You could get some potential free money with the employer's matching contributions. And one of the rules we talk about later on is making sure that you're taking full advantage of whatever matching contributions that they have. And they all have different formulas. So not all employers are the same. Some may do 50% up to the first 6% of your salary or your contribution. Others may match 100% up to 3%. Now, while they both get to the same place and they're both doing 3%, one, you only have to contribute 3% to get the full match. The other, you have to contribute 6% to get the full match. So very important to understand what the formulas are. And then you can also have, as I mentioned earlier, you can take advantage of getting access to Roth contributions. So you don't have to worry about those income limits. You can make as much as you want, and you can make as much Roth contributions as you're legally able to within your retirement plan. The other thing with retirement plans is they have pretty cost-effective investing. They'll have institutionally priced investment options. They can also offer professionally managed options where you can gain advice and have access to tools. So lots of features within the retirement plan space. And then lastly, and this is one that's usually overlooked, is that retirement assets are what they consider creditor proof. So if you got involved in some sort of lawsuit or filing bankruptcy, retirement assets are protected under federal law, and they cannot be touched. They can't go after them in those types of instances. So they're considered qualified accounts, and they are protected in that way. So it's a pretty good feature there. Some ways to maximize your contributions. As I mentioned earlier, there are limits to how much you can contribute, either in an IRA or within your 401k or 403b. So you do want to make sure that you understand those limits. They do change annually, so you want to know how much you can contribute each year. The other is that you have the advantage of you can take advantage of dollar cost averaging. This is particularly in your workplace plan, because each payroll period you're investing a certain amount into the markets, and the markets might be high, they might be low, but overall you're pretty much averaging a certain amount as you're investing on a regular basis. This is a great tactic. It's really how we put people's money to work. We don't always want to throw all of it in at one point in time. It's nice to be able to buy at various different market environments. So great way to kind of average your contributions into the market. And then, as I mentioned earlier, you want to make sure that you're contributing at least enough to maximize that matching contribution that your employer is also making. And we typically think of a rule of thumb as trying to get to a 15% of your salary savings target. So if your employer is giving you 3%, you would want to try to save about 12% of your salary. Now, we know that can't always be done right out of the gate, so we suggest trying to at least maximize the match contribution. And then you have the option of, for most 401k administrators, we call them record keepers, but they're plan administrators. They have tools and features where you can go in and set an amount that you could do every year. So if you're going to get a raise or you're getting a bonus, maybe that's the time that you just set an automatic feature to increase your contribution amount, maybe 1 or 2% every year until you hit that target. It's a nice way to kind of automate that, so you're not thinking about it all the time. And most of the time when people increase from by 1%, it's barely noticeable. So it's a good habit to get into. And then lastly, utilizing your catch-up contributions. So you right now over the age of 50, you can contribute that additional $8,000 in your 401k or 403b. You can also contribute an additional $1,100 in your IRA accounts. The Secure Act last year has higher catch-up limits for those that are ages 60 to 63, and they can contribute an additional $11,250. That's not on top of the $8,000. It's just instead of $8,000, it's $11,250. And again, these amounts will change every year. So just out of curiosity, if your employer does provide matching contributions, are you contributing enough to get the full match? So yes, no, or your employer doesn't offer that matching contribution. I'll give it a couple more seconds to get everyone's feedback. And because we had a good chunk of participants contributing to their retirement plan, I'm assuming we're going to hopefully get good responses here. So go ahead and share the results when they're done. Okay, figure 63% are contributing up to the match. That is great. And then you've got about 7% that said no, and then about 30%, which is unfortunate. That's actually quite a bit where the employer doesn't offer a matching contribution. It does happen. It's not a requirement. The federal government doesn't require employers to match. They just, right now, any new employer does have to actually offer a retirement plan, but they don't have to offer that matching contribution. So Elise, I'm going to turn it over to you to talk about the investments that you could find in the retirement plans.
Great. Thanks, Tina. So as we think about the types of investments that are available in the retirement plans, we'll start broad and then we'll get more specific. So broadly, generally investments can be categorized into one of three asset classes or buckets. And that's what's shown here on the page: cash, bonds, and stocks. So taking these one at a time, cash is probably self-explanatory, right? It's money you can access quickly. It has the lowest risk, but it also is going to grow the least, right? Think about cash as like keeping money in your checking account. That may be a great asset class or category of investment if you are in retirement, but if you're 20, 30 years away, probably not going to grow enough to fund your retirement. Next is bonds. Bonds are essentially loans that you give to governments or companies. So it's like a mortgage in reverse, where you provide that loan to a company or to the US government or a foreign government. And then in exchange, that entity gives you interest payments along the way. Bonds generally fluctuate less than stocks, but they offer more growth potential than cash. So right in the middle of the page here, just to create an analogy here, if cash is a parked car, bonds are like driving the speed limit on local roads. There's some movement, but you're not moving very quickly. And then stocks on the right, stocks represent ownership shares in individual companies. So buying a share of stock means that you own a small share in that company and you benefit as that company grows. Over long periods of time, stocks have historically provided the greatest opportunity for growth. Again, think about the upside potential of especially some companies we see in the news right now. If you own a share of that potential, that can be really accretive to your portfolio. The trade-off is that stock values can rise and fall significantly from year to year. So to keep this car analogy going, if bonds are taking local roads, stocks are like taking the highway. You may experience more twists and turns along the way, but they're generally what help you cover the most ground over a longer retirement savings journey. So, but if you think about it in terms of risk, if you're driving on a long road trip, some highways have unexpected slowdowns, some have construction that backs up for miles, and some are wide open roads. So there's potential for growth, but there's also potential for risk. So how does this work in the context of a retirement plan? Most people don't go into their retirement plan and buy individual stocks or individual bonds. Instead, retirement plans package these individual investments into funds. Think of a fund as a basket containing dozens, hundreds, or even thousands of individual bonds or individual stocks. So what kinds of baskets are available for investing? There's four main types that we'll talk through. Starting on the top left, Capital Preservation Fund. This one is the most conservative option, and the name is a nice clue. Capital preservation. It's looking to preserve your capital that you put into the fund. These are generally the closest thing to a cash-like investment that's available within a retirement plan. They're designed to help protect your money from market ups and downs, and the goal is stability and, again, preserving that capital. The trade-off is because they're taking less risk, they're also expected to provide less growth over the long term. Again, for someone who's 30 years away from retirement, is capital preservation the right goal, or are you maybe looking for some growth to grow your money over time? On the top right, we have actively managed funds. So with an actively managed fund, what that means is that there's a team of professional investors that are making decisions about what individual stocks or individual bonds they should buy, what they should sell, and how to position the portfolio. The idea here is that an investment manager is trying to identify the best stocks or the best bonds to try and outperform the broader market. And you'll see actively managed versions of stock funds, bond funds, and even balanced funds that combine both stocks and bonds together. On the bottom left, in contrast to an actively managed fund, is an index fund. Instead of trying to pick individual winners of this stock is going to be the best, the goal is simply to match the market, such as the S&P 500 or the broad US bond market. Because there's less day-to-day decision making involved, we're not picking and choosing individual stocks, you're buying the whole market as is. Index funds are much lower cost, they're cheaper investments. So the objective of these funds, it's not to beat the market, it's to provide broad exposure to the market itself. So to compare the two, if active management says, let's try to pick the fastest runner, index investing says, let's just own the whole race. And target date funds on the bottom right, this is probably the one type of retirement investment that's most ubiquitous across retirement plans today. It's become one of the most commonly used investments of average people in a retirement plan. So a target date fund, it's really a complete retirement portfolio in one single investment fund that is designed as a set it and forget it fund. I don't know if you guys remember those infomercials back that were on at 2 a.m. of set it and forget it, but that's really what a target date fund is meant to do. That means that once you select this fund, you can forget it. Everything is handled for you from now through retirement. So rather than asking participants to decide how much should be in stocks, bonds, or cash, the funds make those decisions for you. So early in a career, target date funds generally emphasize growth through stocks. And as retirement approaches, the fund automatically, gradually shifts away from stocks and towards bonds and things like capital preservation. In other words, it automatically adjusts over time based on an investor's expected retirement year or the target date at which they're expected to retire. So if I'm 25 today, in my dreams, I could select the target date fund that is closest to the year I'm expected to retire, and the portfolio automatically over time adjusts for me, moving more of my portfolio from stocks to bonds over time as I get closer to retirement. So if there's one takeaway from this slide, it's that retirement plans generally offer participants different levels of involvement. You can choose individual funds and build your own portfolio, like the active managed index-based or capital preservation funds, or you can use a target date fund that does that asset allocation and that rebalancing for you. And the last investment point I want to make is on the next slide, which is on staying the course. So timing the market is very, very hard to do. And one reason, and when I say timing the market, I mean that's pulling your money in and out on different days depending on what the market is doing that day. And one of the reasons it's really hard is because bad days, the big headline, newsworthy days where the market drops, invariably, these are followed by great days, even within the next 2 weeks. It's almost impossible to know when the market will drop and when it will rebound next. So trying to time your exposure, and by time your exposure, I mean selling before a bad day, it's almost impossible. And looking at this chart, you can see how hard it is. So if you look at those first two bars on the left, the difference between someone who stayed invested for 20 years in the stock market versus someone who missed the 10 best days in the market over 20 years. So that second bar, they just missed 10 days over 20 years. And you can see that first person has more than double the assets of that person who missed only 10 days. So staying the course is incredibly important. Again, these funds within retirement plans, they're designed to be robust. They're designed to withstand drops and falls in the market because they're diversified. They're baskets of individual stocks and bonds. That diversification, it helps against downturns. And especially if there's a long time to retirement, staying the course is generally, we would say, good retirement hygiene. So in summary, on the investment section, retirement plans have been set up to make things very easily. You invest periodically over time to dollar cost average into the market. Target date funds and other investment funds can make things easy and give you diversified exposure to broad markets. And staying the course, no matter what markets are doing, is good retirement hygiene.
Yep, that is perfect. Perfect segue. So you summarized everything we've spoken to at this point. We are saving and investing. We're making sure that our investments are aligned with our risk tolerance as well, wanting to make sure that we're not taking on too much risk, something that you'd lose sleep over. So now let's shift gears and talk about distribution options. So what happens after you're either retired or you separate from service. So during your employment, while you're still with your employer, there are some ways to take money out if you chose to. There is a feature called an in-service distribution. Now, I caveat this with not all plans offer this, many do, but you do want to understand your plan features. So an in-service distribution basically means that if you turn 59 and a half, you do not have any penalties. You can take your money out. You can roll it into an IRA, or you can take a regular distribution and you won't be penalized. You will be taxed if it's pre-tax money, but there are no penalties. Another way to take money out during while you're employed is if you suffer a hardship or you have an emergency. So hardship withdrawals are typically allowed in a plan, and this can be something that maybe helps you cover maybe a unexpected medical expense or education cost, first-time home purchases, or a natural disaster. So anything that where you can demonstrate that you've suffered a hardship, you would be able to take money out without any penalty. Now, post-employment, after you leave an employer or when you're retiring, you'll have the ability to take money out in a lump sum. Lots of plans offer you to take it out in a partial withdrawal or an installment payment. You can set up systematic withdrawals, or you can roll the money to an IRA or a Roth IRA. Or you can leave the money in the plan. I don't have that on the slide, but that is always an option. Just because you leave an employer doesn't mean that there's a certain time requirement and you have to take money out. You certainly can leave it. But there are reasons to actually consolidate any prior retirement plans into your current plan, especially if you are over the age, you're in your 70s and you are still working. You do have to, the required minimum distributions do kick in at age 73, but if you are still working, you could delay those distributions, but it's only for the employer that you're currently, or the plan of the employer you're currently working for. But if you took your previous employer plans and rolled them into your current, then it would be all of your retirement money. that you could delay required minimum distribution. So it's just a little trick there. One of the big questions that we get a lot is when someone realizes that all of their money is in this pre-tax and they're getting ready to retire and they think, should I convert it to Roth? There's lots of considerations here. Know that it is a taxable event. So when you're taking your money out of your retirement plan and it's in small little installments, you're just being paid, you're just being taxed on the amount that you're taking out for that year. But if you were to convert your pre-tax money to Roth, that whole amount would become taxable. And you don't have to do the entire account, you can do portions. But it is important to know that that becomes a taxable event. So sometimes when we are looking at it from a planning perspective, we're seeing if someone's going to be in a low income year, it might be a good time to do a Roth conversion. But those are typically something that is available. Many retirement plans offer that in plan, so you could do that within your retirement plan before even leaving or having to take a distribution. You can convert. The other option is to take that money and then roll it into a Roth IRA. But again, know that that would be something that would become taxable. So the question here is, having gone through our investments, our distribution options, our loans, how familiar are you with your employer's retirement plan features? And we've got very familiar, somewhat familiar, I have no idea, or you're currently not participating. Give that a couple more seconds. All right, well, let's go ahead and throw those results up. We got a little mixed bag here. So about 42% said they were very familiar, 42 said somewhat familiar, 4% have no idea, and then 12% are not participating. So the great thing is over 80% are somewhat familiar with it. What you can always do if you wanted to learn more about the plan, there is an annual document called the Summary Plan Description. That is something you can ask from your employer, and it'll outline in pretty easy language, easy to see, what your features are. So always a good idea to just make sure that you understand what your current retirement plan is offering. So as Elisa
Tina,
alluded to earlier.
Elise, Tina, let me
Oh,
just
go
say
ahead.
we have about another 5 minutes before we have
Yeah.
to turn it over to questions. I just wanted to give
Perfect.
you a little
chat.
time frame here.
Yep, we're going to quickly go through some common mistakes. There's 5 of them, so this should be pretty simple. So I'll go through the first one here. The mistake number 1 is starting too late. One of the things we say all the time is save early and save often. So if you can start as soon as possible, even if it's a small amount, compounding really does make a big difference. And then within retirement accounts, there's ways to automatically set that up. So great way to get things automated. Warren Buffett, one of the greatest investors of our time, famously said, do not save what is left after spending, but spend what is left after saving. So those are words I try and live by. And this is just an example of how it really does pay to start early. So here, this is an example. You've got Ellen, who started saving at age 24. James started saving at age 35. They both have an end date of 65 for the amount that we're going to approximate for their savings. And they both contributed $100 a month with the same rate of return. And you can see, because Ellen started 11 years sooner, she actually had over $200,000 more in savings. So it makes a big difference when you have more time on your hands. Elise, I'll have you go to number 2.
Yeah, I think the same thing is, as Tina said, save early and save often. And I think not saving enough can also hurt over the long run. So one tip that we talked about maximizing employer contributions, but one tip that Tina said, just to underscore, is if your plan has an auto escalation feature where the plan itself might allow you to just turn that on, where automatically at the beginning of every year your contribution rate will increase by 1%. Or you can do it yourself. Kind of a rule of thumb that we have is that that when you get your salary bump hopefully everyone gets if you get a salary bump that year, you can increase your contribution by 1%. And like Tina said, it's a little not noticeable. So if you go to the next page, you can see the impact on what the difference is between saving 1% of your salary, 3% or 5%. And you can say the actual dollars it's pretty small week to week, right? It's delayed gratification. So set $8 a week versus 24 versus 39. It doesn't feel as good immediately, but over that long term, just increasing by 2%, right? For each group here definitely helps in terms of outcomes at retirement.
And mistake number 3, not diversifying investments. And Elise talked about, the various different types of investment options you have and the importance of diversification. We talk about kind of spreading your risk, and I'll show you on the next page why this is so important. But the other option that you can, or the other feature of making sure that you're in a proper allocation for your risk tolerance is also making sure that you're rebalancing on a regular basis. And you can see this when we're going through bull markets where the market continues to rally. A lot of people can get over allocated into equities. But if the market corrects and they haven't rebalanced, then their portfolio could go down much more than they were comfortable with. And so the target date funds that Elise was talking about earlier, those have that automatic feature. They automatically rebalance and they automatically move with you to manage risk as you're getting closer to retirement. So those are a great tool to have. And you can see here, these are different asset classes, everything from cash to small cap companies to real estate to commodities. And you can see that there's no one winner every single year over and over. It just bounces around all the time. But in the middle there, this is the asset allocation, basically a blended or balanced portfolio. And even after we went through a global financial crisis, we went through a pandemic, and through all of that, the worst case scenario for a balanced portfolio was down almost 14%, which happened in 2022 when we saw stocks and bonds going down. But it is really important to have a good diversification because we see this, market leaders changing year after year. At least I'll have you do the.
Yeah, we're short on time. Underestimating expenses in retirement. I think the biggest thing to point out here is healthcare costs. Healthcare costs continue to rise significantly. If you go to the next page, you can see that the average, again, this is an estimate, but out-of-pocket healthcare expense estimate for a married couple is about $330,000 in the US today. So just having a sense of budget, but also budgeting more than you think for healthcare, especially late in life.
Yeah, that's a great point. And then the last one here is not considering taxes. So we talked about pre-tax and Roth, really just understanding the different types of retirement accounts you have access to. And then normally our rule of thumb is, as far as taking money out, is to have a variety. So if people don't know if they should do one or the other, sometimes it's good to just have a blend and have a variety of different types of accounts when you're retiring. So whether they're taxable, your regular savings account or a brokerage account, tax deferred accounts would be your pre-tax accounts, and then Roth accounts. And this is kind of the hierarchy of how you would actually start taking it out, because you want to defer taxes as long as possible.
Well, this is such fabulous information, ladies. Thank you so much. The one chart that always strikes me as incredible, it sounds unbelievable, is that the difference between starting early and just 10 years later. And by the way, when we ask people what the biggest lesson they learned, they said start early. So, I mean, it is really amazing, that compounding. So we're going to turn it over now to questions, and another fabulous board member, Sonia Strada, is going to field them. So over to you, Sonia.
Thank you. Such an important topic, and you both did a fantastic job explaining it. We've gotten a number of great comments saying that and also a number of great questions. So let's start by answering a few of them. A lot of them focus around retirement, obviously, but then the topics that you didn't talk about that pertain to ways to save for retirement. For example, can you include some information regarding a solo 401k?
Oh, so that would be just an individual business owner that has their own 401k that they want to set up. Those can be done. It really depends on what the business owners what their objectives are. I don't know exactly what what specifically to go into, but those are pretty specific arrangements. We don't do a lot of those, so at least I don't know if you have any context there or not.
Yeah, I think especially a solo 401k, I mean it's an interesting topic where you can set it up for effectively yourself as a business owner. One thing you also may want to look at too, that person is the state-based auto IRA plans. Depending on what state you're in, there's been about I think 17 states have passed laws where if a company has one employee or more, they have to set up a plan and they can either create their own plan like a solo 401k or they can send their payroll to the state-based plan. And the benefit of those plans, the state-based auto IRA plans is there's a lot more people in them. So those assets get bigger and that allows that plan to negotiate fees pretty low. So I think the headline here is there have been advancements and now there are great solutions for people who are self-employed or work for small businesses, either through a solo or through the state or through a lot of states. There's some great solutions there for folks looking to save.
That's really
Yeah, and
helpful. Oh, so
I'll
go
also
ahead.
bring up something that because there are some administrative costs, and you do still have to do some IRS filings whenever you're going to set up a 401k. There are some options for small employers, even sole proprietors that can join pooled plans. They're called pooled employee plans or PEPs. And these are plans that are already set up. They already have investment options. They take care of all the administrative functions, but you can just kind of pipe in as an adopting employer. And that may be a better solution. Some payroll providers like ADP and Paychex have their own PEPs. So it could be something to look into that might be a little less burdensome.
That's very helpful. So here's another type of retirement plan, a simple. So if an employer is opening up a simple, do all the contributions have to come from the employer or can the employee also contribute?
Yeah, and I'm trying to think if it's the simple or the SEP. I think the simple, and might have to come back to this one. I think the simple is employer funded.
I think the I thought the simple I could be wrong. I thought the simple was the employer has to contribute, but I think the employee can
Can
contribute a
still,
little
yeah,
bit as well.
yeah. So yes, they can. And it's a little different. So the deferral rate for like a solo 401k is the regular 401k deferral rate of 24,500. In a simple IRA, it's 17,000. So the contribution limit's a little less in a simple,
Great.
but they can make contributions.
Okay. And so here's a question for after retirement. Can you contribute to an IRA after retirement? And is there a max contribution age, or does it depend on if you're still working or not?
Yeah, with an IRA, it has to come from earned income. So you can't, if you're not working and you have no earned income, then you're not making contributions.
Perfect. Okay. What about what should someone do if they started saving later in life and they feel like they're really behind?
Um, well, don't panic. Don't start taking probably more risk than you're still comfortable with. There are some features that you can take advantage of. So that we talked about before, the catch-up contributions. So what I would look at there is seeing if there's ways that you can maybe reduce spending and increase your saving. You may have to possibly adjust your plan, depending on the situation. So probably working with an advisor or planner to really spell it out and see what your options are at that point. But I think one of the things that a lot of people do tend to do is find themselves getting into riskier investments because they're trying to make up time or make up their savings, and that's probably the one thing I would say not to do.
Yeah. There's also, we didn't touch on this really, and this webinar probably goes beyond the scope, but there are things out there that can help, right? That I think Tina mentioned a couple in terms of contributions, but there's also, if you think about how to generate sufficient income in retirement, a tool like a deferred annuity, right, is a way to do that. And I absolutely am not giving any kind of advice on this, but a deferred annuity, what it does is you purchase it using assets today, and it pays you out a guaranteed income stream later in retirement, say age 75 or 80. But because there's that deferral period where the insurance company gets those assets, the insurance company can actually invest those assets and make profit off of it. So you as a person, as a participant, you get a lot more bang for your buck from that deferred annuity income, like 2 to 3 times more from just an immediate annuity. So there are tools out there where even if the level of assets you have at retirement isn't what you want, there are tools out there to really stretch your dollars and maximize your dollars. And I would say a deferred annuity is one of those.
Interesting.
The other thing I would also say is not to forget what your Social Security benefits are. I think there's
Yeah.
always this sentiment that it's not going to be around or that it's going to be reduced, but really having a lens on what that is going to be so you really understand what kind of income you're going to be drawing.
Yeah. And delaying Social Security is a great way to increase your income level too.
Those are both important points. Yes. Another question. If an employer is offering a Roth 401k, but they won't initially match, do you advise still contributing despite the fact there is no match?
Yes.
Absolutely.
Yes, just getting into any kind of savings habit is important. So even though you don't have a match, being able to save pre-tax or even after tax, depending on your current situation, I would say yes.
Yeah. And I get asked the question of how much should I have in Roth? How much should I have in pre-tax? Just have some in both, right? Diversify. That way you've got options so that depending what your income is 1 year in retirement or depending on if tax rates change because administrations change in the White House, right? You have optionality there. So it's never a bad thing to have both pre-tax and Roth saved when you're in retirement.
Very good point. And I think this might be our last question,
Yeah.
but
Sonia, last question.
okay, great. What should investors do during a significant market decline if they're close to retirement?
That's a good one. I'll jump in on this one. So I think it's very similar to kind of what I said earlier. Don't panic. Elise went through kind of the, time in the market versus timing the market. And really, when we look through business cycles and we look through rolling periods of market returns, rolling periods over 3 years are generally positive. So even though you're close to retirement, you're not going to be having to pull your entire amount out and use it in year one. You have time, you still have a runway. So stay true to your strategy. But there are some considerations. If you don't have to spend as much, maybe in one of those, those down years, maybe try not to. But definitely stay the course.
Yeah, I agree. Totally agree. If you're right before retirement, stay the course. The funds that you're in, especially if you're in a target date fund, it's designed for this. It's designed to withstand this and recover. If you're in retirement and you're already withdrawing money, I would say maybe see if you can take a little bit less out from your investments that year. Because what happens when you take those assets out of your 401k plan to fund your income in retirement, you're that's you're kind of freezing that money, right? You've locked in those losses because you've sold out at that point in the market. So that piece of your income, that's kind of that gain or loss, which is probably a loss, is then locked in. So to the extent that you can flex a little bit and take a little bit less out and leave the rest invested, and then when the markets go back up, you can take a little bit more out, right? So I would say you can react a little bit at the margins if you're already in retirement. But yeah, stay the course and stay invested.
Well, we have to thank you too. And also Sonia, thank you for handling the questions. There's such great advice. And I'll pass on some advice that came from Christine Benz, who's in charge of personal investing and retirement at Morningstar. You know, as people approach retirement, go to a financial advisor, just even if it's a one-time review of your investments. Or you go earlier and ask some of these questions for a one-time consulting if you don't really want to retain an advisor. You might get some good ideas. And people do this for, one-time charge. So in any case, we'll continue. I urge you to go listen to our other webinars on the subject of retirement. It is complicated, but just start early. I think they will put that. And the other point that make is diversification. There's a saying on Wall Street that says diversification is the only free lunch. And it's true. To diversify and you're going to make out better. So in any case, thank you all. Thank you to our participants here today and hope you enjoyed it. Let us know how you feel about this. Until next time. This is WISE. We're always here. Go to our website, sign up. It's free. Thank you so much.
Thank you, everyone.
Bye-bye.
Bye-bye.
Bye.